we don't have enough housing in the places that people want, and that the US needs more housing overall. And really, I think it's going to be an all of the above approach as to how we accomplish that. And I think one of the partners that hasn't been looked at as carefully over time, as they're still fairly new, is these large single family landlords.
Hello and welcome to the REIT Report. I'm your host, Sarah Vauxhall-Quito. Today we're looking at housing trends in the single-family rental sector with my guest, Colin Trovato, Portfolio Manager at Ranger Global Real Estate Advisors. Ranger Global is an independent investment advisor focused exclusively on the active management of global real estate securities portfolios for institutional and individual investors. Colin, welcome to the podcast.
Hey, Sarah, thanks for having me. Appreciate the time.
So, Colin, how have higher interest rates since 2022 impacted home ownership and influenced the demand for single-family rentals?
Thanks for the question, Sarah. So there have really been a confluence of factors that have impacted single-family rentals in the last few years. The most significant of which that you point out is higher interest rates. Now, these higher interest rates have really had two main impacts. The first is just that higher rates have made the overall cost of buying a home higher, obviously, as interest rates have more than doubled since the bottom in 2020. The fact that home prices have continued to grind higher despite higher rates has just intensified the affordability problem, particularly for first-time buyers. The second factor is that higher rates have effectively frozen the housing market in place as existing owners have become locked in to their low-rate mortgages, making the cost of moving to new homes especially large. So this has reduced the amount of inventory available to buy about 50% of normal inventory levels. So those two factors together have really been a positive demand tailwind for single-family rentals, both from an affordability and an availability perspective.
And everyone's talking about lower interest rates coming anytime soon. Does that change the dynamic for this overall picture?
Historically, renting a home has been about 5% more expensive than buying, whereas today it's roughly 28% cheaper to rent versus buy. So you're starting from a historically large favorability for renting. And as a starting point, the dynamics are currently vastly tilted towards renting. But on the margin, yes, lower rates should make purchasing a home more affordable. However, given the large gap that we're starting at, with mortgage rates still close to 7%, we'd really need to see something closer to a 200 to 300 basis point decrease in mortgage rates from here before the rent-to-buy equation began to swing back towards historical standards, assuming, while that occurred, that home prices remain relatively static. Even if that were to occur in the near term, which we'll see, it's hard to predict interest rates, obviously, the historic underbuilding of housing and a shrinking supply of rental housing overall, combined with the large demographic tailwind of millennials aging into prime single-family years, should keep the overall supply and demand environment fairly healthy, even with the potential for lower rates. So I think the dynamic of being favorable to single-family rentals, even with changes in interest rates, should continue to be fairly healthy.
And as you mentioned, that scarcity of housing inventory, you're saying that's playing a really key role in driving renters towards single-family rentals.
Yeah, that's true. So as mentioned earlier, the U.S. hasn't been creating adequate new housing really since the Great Financial Crisis. But in addition to that, the overall equation is probably even more skewed in areas where people want to live, as existing stock in areas with declining population isn't relevant for growing metros. The other impact of this underbuilding has been a general aging of single-family housing stock in the U.S. As a consequence, for existing single-family homes for sale, in addition to the high upfront costs, it can be thought of as deferred maintenance costs are also fairly large in the picture, particularly where a home equity loan will also be expensive if you were thinking of buying a fixer-upper and needing to work on it. Large institutional landlords like American Homes for Rent and Invitation have really been addressing this problem in two ways. So one, they're just delivering new units that wouldn't otherwise exist. And secondly, they've been buying existing homes and investing in them to bring them up to date using their own capital. So as people continue to look towards growing areas for move-in ready housing, even with means for down payment, the lack of inventory has really been a positive tailwind for the SFRs. And particularly when you look at where we've had at least a decade of migration towards the Sun Belt, which while it has slowed somewhat in recent years, that trend is generally fairly intact. And so the need for housing, particularly single family housing in the fastest growing metros, just continues to outpace what's being built. And thinking about the threat of maybe home builders really stepping up the amount of homes they just deliver to start to meaningfully narrow the undersupply gap just doesn't seem really realistic at this point, as home builders themselves have developed fairly good business models and are scarred by the financial crisis to not to want to get too far over their skis with speculative housing for sale. So I think that the scarcity of housing will continue to push young families into single family rentals as an attractive option.
In the first quarter, we saw about a 20% jump in the construction of single-family build-to-rent homes. That's according to the NAHB. Do you see build-for-rent playing a larger role in the single-family rental landscape?
Build to rent will be a larger part of the landscape in the future for a couple reasons. The first of which is that realistically, there are some meaningful differences between housing that is built for sale and housing that is built for rent. A few examples of that is, as landlords have found out, that there's some distinct differences you want, such as in a rental house, you realistically want more hard surfaces. So hardwood floors throughout the house. Think about covering that with rugs rather than carpeting, or simple things. You may want the washer machine by the garage on the first floor rather than on the second floor, which you would see in more of a build for sale house. And simple reasons for that are wear and tear. And if you were to have a leak, for example, with your washer machine, it's better if that is on the ground floor and has less potential to cause damage. There are some subtle differences that do distinguish these two types of stock enough to make them be somewhat distinct components of the same type of housing overall. And so I also think over time, institutional landlords, as they gain scale, will want more control over design, location, and really the cadence of the growth that is being offered. And secondarily, I think that the U.S. is being severely underbuilt at this juncture. Institutional landlords really have the opportunity to be part of the solution in providing affordable housing, as I think sometimes they are unfairly painted as removing housing from the market overall. But the reality is, just like in the multifamily market, I think there's a growing need for many flavors of single family housing. Of course, single family homes owned by residents will remain dominant overall, but providing a quality single family rental option that is professionally managed like apartments provides a beneficial option for people. So I do think that as these companies mature, they're going to also want more control over their growth trajectory and not be beholden to a home builder's growth plan, so to speak. So I expect it to become a bigger part of the overall housing picture going forward. And I think that's going to be a healthy development.
And Colin, other factors that are contributing to the appeal of single-family rentals for millennials and other demographics?
As we've seen, the world today continues to accelerate in all sorts of different ways, whether it is millennials are forming families later, switching jobs more often, really trying to find where their place in the world is, whether that's closer to the family or further away. And it's just taking a longer period of time. So as the world continues to accelerate, there really are a lot of advantages to renting versus owning, namely the flexibility that I cited that millennials appreciate, particularly after a financial crisis. The other thing that's become a lot more prevalent is that there are a lot of other means to save money other than home equity these days. Rather than putting money into your house every month as a forced savings mechanism, with a lower rental payment, you could take the difference and invest it in the market or in bonds or with any other type of investment option that I think become cheaper to do. The platforms are easier to utilize, and I think millennials are more aware of those options. So I think with other means to save other than home equity and the flexibility to change your home with relative ease, really for whatever reason, whether that's needing to change jobs, wanting to change school districts for your kids, or your general preferences dictate, moving out of a rental versus selling your home is just a lot easier. And I think millennials see the myriad of benefits of coming versus renting versus owning as really being a positive good in of themselves.
How have SFRs performed relative to other residential property types?
So over the past 5 years, single-family rentals have had much steadier rental and income growth than their multifamily peers. The first of which, the obvious one, is they avoided much of the drawdown during COVID that multifamily saw, as suburban areas and the desire for having more living space were prevalent during COVID, and our urban cores were clearly hit a lot harder. So I think that was probably more of a one-time impact that, absent another pandemic, I think is somewhat of an outlier. But I do think another trend that is currently impacting multifamily, particularly in the Sun Belt, where most of these single-family residential homes are, is we have had, with low interest rates, a pretty large explosion of multifamily development that has taken place. And so that has changed the supply-demand characteristics of the multifamily market significantly in the last few years, which has largely sidestepped single-family. So that's another kind of more cyclical, building-related impact that single family has avoided. But then the last one that I think is more durable is just a single family rental stream, the nature of your tenant, he or she's going to live in that house for a longer period of time. I think for multifamily rental, 2 years would be a longer stay, but 18 months is more your typical average stay in an apartment. 1.5 years, people stay 1 to 2 years. By the time you're starting to look at single family, and this has evolved as the industry has matured, they started at a 2-year average tenancy at the beginning, but those are starting to gravitate up towards 4 years and potentially has the opportunity to go towards 5 years over time. And that makes sense because if you move into a single family home with your pets and your kids, and you've got your kids in school and you've got your 2 cars and you've got all your furniture set up, just like owning a single family home, the move's just a bigger deal. And chances are you're just in a more set, less mobile portion of your life at this juncture anyway. And that lends itself to a landlord to two kind of advantageous things. It's like, one, as long as you get a good tenant, you're not going to be dealing with having to turn the property nearly as often. And so your business model becomes much more about maintaining a good relationship with your tenant and increasing your revenue on renewals year in, year out. And that is just a more predictable, steadier growth model that has really inured to their benefit. And I expect to be a large part of the story going forward as that tenancy continues to stay just longer by its very nature, which should give you more compounded earnings growth, particularly when you think about the expenses involved in just turning a house, the walls, refinishing the floors, and all these other things that you just avoid. And that, of course, has led to stock performance outperformance for the public single family companies versus the multifamily companies.
Yeah, on that topic, you've already mentioned AMH and Invitation Homes. Can you talk about how they've set about growing their portfolios and also their investors' capital?
Yeah, so both these companies originated out of the great financial crisis, largely buying homes on the auction steps for courthouses out of foreclosures. So that was their genesis, both platforms. But they both matured, and now they have while how they're growing their portfolios are similar, there are distinct differences. So AMH has built one of the largest home builders internally managed in the country at this juncture. And so their primary method of growing their portfolio is through self-built and delivered homes into their portfolio. So they do have a land bank. They go out there and scout new neighborhoods, design communities, and deliver homes, rent them up, and own those homes over time. That is their primary way of growing the portfolio, whereas they still also supplement that with open market transactions. If there's homes they want to buy off the MLS, they still do that, or relationship deals with home builders, or even other portfolio deals. So they play in all the different lanes, but I'd say the distinctiveness of them is their build-to-rent platform that they've developed over the last decade. Invitation, on the other hand, has their own kind of unique thing. So they have historically been more of they do not have their own internal development platform. So they have been a buyer of properties. They have also done bigger deals. Invitation merged with Starwood Waypoint years ago. So they've grown more episodically that way. But the new thing that they've really brought about is they've launched a third-party management platform, similar to what the storage industry has. Whereas if you are an institution that has a portfolio of homes, Invitation will now offer for a fee to manage that for you. And managing homes, as you can imagine, when they're spread out is operationally intense, and it does take a certain amount of scale to really effectively manage that. So Invitation is in early days of this, but they are looking at this for two ways. One, it will bring in fee revenue and leverage their existing service infrastructure on gaining scale, which is a good thing. And on the other, it does give them, they believe, a pipeline of homes they might be able to purchase in the future from their partners at this juncture. And so that's really the way they've been doing it. And then on the build to rent side, I think been more invested in purchasing from home builders and developing those relationships as they've basically outsourced development of that sort to home builders, which is also a good model. So there are slightly different flavors of how they did that. And then on how they manage their investors' capital, realistically, both these companies, they're REITs, so they do have to pay out their taxable income in dividends, but both of them are able to retain a pretty decent amount of their internally generated cash flow for internal growth, whether that's through developing and delivering new homes as an AMH or purchasing new homes as an INVH. And so just the natural retention of cash to grow the portfolio is one way that they grow their investors' capital. And then on the other one, as mentioned earlier, is just compounding income growth over time as their existing homes increase rents over the years, grow income. That's really the investors' capital growing along with it.
And Colin, looking ahead for a bit, what's next for this sector? Do you see it really stabilizing at current levels, or could it play a larger role in the broader residential market?
That's a tough question. I think it'll play a larger role in the future. I think one of the things that's beginning to be recognized and is part of one of the larger pushes we're seeing in this country is just a general recognition that we don't have enough housing in the places that people want, and that the US needs more housing overall. And really, I think it's going to be an all of the above approach as to how we accomplish that. And I think one of the partners that hasn't been looked at as carefully over time, as they're still fairly new, is these large single family landlords. And I think they've got a large or a part to play in increasing the amount of housing overall. And they have a large sticky capital base that enables them to do that in a way that is probably steadier than what a home builder does, which has a much smaller capital base and is much more dependent on, let's say, spot financial conditions of the American consumer. Are we in a recession? Or is it flush times? Where are interest rates at? And I think a more predictable growth cadence that the single family guys can plan for over the next 5 years and how they want to evolve their portfolios and where they see growth going and planning to deliver homes that people will want to rent in the future. I think it's going to be important. And I think that in of itself will make it have a larger role as the appeal of single family rentals continues to increase. Because I think one of the things that is lost in the shuffle here is that there has always been a fairly large single family rental market in the US. And over the last few years, that market has actually been shrinking as your traditional mom and pop landlord has been selling their home, maybe after COVID or for whatever reason, into the homeowner market. And I think that the bringing what we have found in the multifamily market, where you can search for homes easily, know that you have a trusted counterparty on the other end. If you wanted to move houses, you could go to AMH's or Invitation or any of the private players' websites, and they could show you homes they have available down to the neighborhood, show you what the school district is, and you have some expectation and confidence that your landlord is going to operate in a predictable and responsible manner. I think that is something that is fairly new to the single family rental market, where historically you've just been a lot more dependent on the particularities of your small landlord, which could be great and could be not great. As small landlords sometimes are very good at managing their properties and have plenty of cash to maintain them, and sometimes they do not, or have life events or any other things. So I think that is just another tangential reason why they should play a larger role going forward, and I think that they will.
Colin, thank you so much for sharing your thoughts today.
Yeah, thank you for your time. I hope this has been interesting.
And to our listeners, if you enjoyed this episode, please leave a review or subscribe on your favorite podcast platform.